You saved for decades inside a pension abroad, played by every rule, and still watched a third of it vanish. Not to market losses, but to your home government treating that account like a taxable brokerage wrapped in red tape. This isn't a fringe case. Millions of expats are building retirement savings in one country while a second country quietly claims legal authority over every dollar inside. The first surprise is classification. In the country where you open the pension, say Germany or Australia, your account is a protected retirement vehicle. Contributions may be tax deductible, growth is tax deferred, and the government treats it as untouchable until you retire. But your home country never agreed to that framing. To the IRS, to HMRC, to the CRA, that account is a foreign financial account, and foreign financial accounts must be disclosed. The pension wrapper your host country built around it is invisible across the border. The disclosure thresholds are lower than most people expect. For Americans, the FBAR rule fires the moment your aggregate foreign account balance exceeds $10,000 on any single day of the year. FATCA's Form 8938 kicks in at $50,000 for a single filer living in the U.S., or $200,000 if you live abroad. Take a concrete case. An American in Germany opens a Riester pension now worth $85,000. She hasn't withdrawn a cent, owes nothing to the German tax authority yet, but she must file both FBR and Form 8938 every single year. Missing either isn't a technicality, it's a penalty event. So reporting is mandatory, but you might assume the tax itself isn't a problem if your two countries have a treaty. That assumption is where things get genuinely painful. Tax treaties almost never give a foreign pension the same tax-deferred status it enjoys at home. The treaty might acknowledge the pension exists, but if it doesn't include an explicit matching deferral clause, your home country taxes the account as if the wrapper isn't there. Contributions that were tax-deductible in the host country become taxable income in your home country. Growth that accumulates tax-free over there gets taxed annually over here. The UK ISA case shows exactly how this plays out. A Canadian working in London contributes $5,000 to a UK ISA. Inside the UK, an ISA is entirely tax-free. No tax on interest, dividends, or capital gains, ever. Canada doesn't care. The CRA doesn't recognize the ISA as a sheltered vehicle, so every pound of growth earned inside that account is reported to Canada as regular foreign income and taxed at the Canadian marginal rate each year. The shelter that makes the ISA valuable in the UK is completely eliminated from the Canadian perspective. You're paying for a benefit your home country won't honor. The treaty gap is bad. What comes next is worse. The U.S. has a special classification called a passive foreign investment company, PFIC, and many foreign pension funds that hold pooled investments trigger it automatically. When a pension is classified as a PFIC, the IRS doesn't just tax the gains at the ordinary rate of 37%. It applies an interest charge backdated to every year the gain was accruing inside the fund. Think of it as the IRS collecting the tax it would have collected if you'd been paying every year, plus interest on the delay. The effective penalty rate on gains in extreme cases reaches roughly 50%. Run the numbers on a real case, and the damage becomes concrete. An American in Australia holds a $200,000 in an Australian managed fund superannuation option for 10 years. The fund grows, and at withdrawal she has an $80,000 gain. The IRS classifies the managed fund as a PFIC. That $80,000 is taxed at 37% ordinary income. That's $29,600, and then the interest charge is applied back to each of the 10 years the gain was building up inside the fund at roughly 8% per year on the deferred tax. Add it together, and she loses somewhere between $40,000 and $50,000 of her $80,000 gain to U.S. tax and interest alone. Half her profit, gone, not to bad investments, but to a classification. Even if you survive the tax classification, there's a second wall you haven't hit yet. The host country's own lock-in rules. These aren't loopholes or edge cases. They are the core design of many pension systems. Australia's superannuation cannot be accessed before age 60. The UK's minimum pension access age is currently 55, rising to 57 in 2028. Many continental European occupational schemes don't allow lump sum withdrawal at all. They pay a monthly annuity starting at local retirement age, typically 65 to 67, and that's the only option. Early withdrawal, where permitted, carries a penalty of 20 to 40% on top of income tax. The host country isn't being obstructive. That's simply how the system was designed, for people who stay. The Dutch example makes the lock-in visceral. A 45-year-old British citizen leaves the Netherlands after 8 years of work, with $60,000 sitting in a Dutch occupational pension. She calls the pension administrator to transfer or withdraw it. She can't. Dutch law prohibits lump sum extraction from occupational schemes. The money stays in the Netherlands, paid as a monthly euro annuity starting at age 67, 22 years away. She can't move it to the UK, can't access it early without forfeiting the bulk of it. And for every one of those 22 years, the purchasing power of her future annuity is quietly being reshaped by whatever happens to the pound-euro exchange rate. The money is legally hers. She just can't reach it. Assume you've cleared the classification hurdle, survived the lock-in, and you're finally drawing down your pension in retirement. You might think a tax treaty protects you from being taxed twice. It often does, but the treaty's tiebreaker rules work in a way that surprises most people. The key is that the treaty looks at where you live at the time of withdrawal, not where you contributed. Your country of residence at retirement gets primary taxing rights. Then the source country may still levy a withholding tax of 15 to 25% on the payment. Your residence country then grants you a foreign tax credit, but only up to its own rate. If the withholding is higher, you eat the gap. And if there's no treaty at all, both countries tax simultaneously with no credit. The no-treaty scenario is the worst version. A British retiree living in a country that has no pension treaty with the UK receives a pension distribution. The UK withholds tax on the way out. The country of residence taxes it on the way in. There is no mechanism to credit one against the other. Both governments collect in full. The same income is genuinely taxed twice. The Portugal worked example from the other direction shows that even where a treaty exists, the outcome is residency dependent. Under the US-Portugal arrangement, Portugal taxed the US pension at up to 28% as the residence country during the NHR period, terms that changed as Portugal's tax regime changed, something the retiree cannot control. There's a third erosion that operates silently in the background of all of this: currency risk. Your pension is denominated in euros, or yen, or Australian dollars. You'll spend your retirement in pounds, or dollars, or whatever currency your home country runs on. Every year, the exchange rate between those two currencies shifts, and inside most pension structures, you have no legal ability to hedge that exposure. A 10% adverse move on a $200,000 pension wipes $20,000 of purchasing power in a single event. Over a 20-year retirement with roughly 3% annual volatility in a major currency pair, the cumulative swings can be enormous. And unlike a market loss, a currency loss doesn't mean the assets declined. The assets are fine in euro terms. You're just poorer in the currency you actually spend. Run the British expat's numbers and it becomes permanent income loss, not a theoretical risk. She returns from 15 years in the Eurozone with a $150,000 German pension paying a $10,000 annual annuity. When she left, the pound bought 1.15 euros, so her annuity was worth about $8,695 a year. Over her early retirement, sterling strengthens to 1.35. Her annuity is still $10,000. The German insurer is paying exactly what was promised, but in pounds, it's now worth only $7,407. That's a permanent income cut of $1,288 every year for the rest of her retirement, compounding forward with no mechanism to recover it. She cannot ask the pension to hedge this for her. She cannot renegotiate the annuity currency. The exchange rate simply moved, and her retirement income fell with it. Every one of these traps, the reporting obligation, the PFIC classification, the treaty claim, the currency exposure, requires action on a specific deadline. Miss any single one and the trap closes permanently. FBAR is due April 15th, auto-extended to October 15th. Form 8938 attaches to your annual return. Form 3520 covers foreign trust classification for some pensions, due April 15th. And the most dangerous, a PFIC QEF election, the annual mark-to-market mechanism that converts future PFIC treatment into something manageable, must be made in the first year you own the account. You cannot go back and make it retroactively. That window closes once. These deadlines don't coordinate with each other, and they don't send reminders. The penalty structure for getting this wrong is designed to be existential. A willful failure to file FBR carries a penalty of the greater of $100,000 or 50% of the account balance per violation year. That means 3 years of non-filing on an account worth $200,000 could generate $300,000 in penalties before the IRS has calculated a single dollar of tax owed. The Irish PRSA case, An American opens the pension at 35, doesn't file Form 8938, doesn't make the PFIC QEF election. At 50, he discovers the error. Retroactive PFIC treatment means tax plus 8% annual interest on every year of deferred gain, 15 years of back interest. 3 missed Form 8938 filings are $10,000 each, a $30,000 floor penalty, before the pension itself is even addressed. Step back and look at all 6 failure modes together, and a pattern emerges. Each one is independent. You could survive the PFIC trap and still get destroyed by the lock-in, or clear all the tax issues and lose a decade of purchasing power to currency drift. They don't cancel each other out, they stack. The foreign pension isn't inherently a bad savings vehicle. In the host country, for someone who stays, it may be excellent. The problem is that it was engineered for a single country life, and the moment you carry it across a border, you are simultaneously subject to 2 legal systems that were not designed to cooperate with each other. The mechanism that makes all of this so dangerous is that every layer was designed with different logic by different legislators in different decades, and they compound on each other. A reporting failure blocks your treaty claim. A missed QEF election turns ordinary pension growth into a PFIC event. A lock-in rule prevents you from taking money out to pay the tax bill your home country just sent you. The currency move happens regardless of how well you managed everything else. No single actor designed this to hurt expat savers. It emerged because each country legislated for its own residents, and the gaps between systems fell on the people living in between. Understanding the architecture of the problem tells you what to look for before you open anything. The sequence that protects you runs in the opposite order from the sequence that destroys you. You identify the classification question first. Is this account a PFIC, a foreign grantor trust, or a recognized pension? You make all required elections in year 1. You file every disclosure form annually, and only then do you engage the treaty to determine what the actual tax cost is. Skipping any step in year 1 is not recoverable. The system has no grace for retroactive fixes when the failure was in the initial election. That asymmetry, easy to get wrong, expensive to correct, often impossible to undo, is the real structural trap a foreign pension sets. A foreign pension is not a retirement plan that happens to be in another country. It's 2 retirement plans occupying the same account, one governed by the host country's rules, one governed silently by your home country's rules. And those 2 plans will never fully agree on what the money is, who can touch it, when it can be accessed, or how much of it is yours at the end. The account looks like a savings vehicle. What it actually is, once you carry it across a border, is a compliance object living at the intersection of 2 tax systems that weren't built to share. The money is real, the lock is real, and the key is usually back in the country you left.